The biggest confusion most people have is this: are mutual funds better? Are ETF the smarter choice? What's the real difference between the two? And more importantly, which one should you choose? Every year, lakhs of investors lose money just because they make the wrong choice. Let's make sure you don't fall into that trap. In this video, we will break down everything you need to know about exchange traded funds, ETFs. What exactly is an ETF? How many types of ETFs are there? How should you invest to get maximum profit? And at the end of the video, I will share you the top 5 best ETFs to invest in 2025 based on data and performance. So stay with me till the end. This video could genuinely help you make smarter investment decisions. So what exactly is an ETF? Think of it as a mutual fund, but one that you can buy and sell like a stock. For example, let's say you are checking the stock Reliance. If I type Reliance, you will see the current share price of Reliance Industry, which usually trades around 1,447. Now the stock market is open on weekdays from 9:15 am to 3:30 pm. During these hours, you can buy or sell any stock. ETFs as well work the exact same way. You can buy or sell them live during market hours just like a regular stock. Why are ETFs becoming so popular? In the last few years, ETFs have seen a massive rise in popularity. A while ago, they were barely even visible in the Indian investment space. But today, ETFs make up nearly 13% of total mutual funds industry AUM, and that number is still growing. This clearly shows that ETFs are no longer niche. They are becoming a major part of how smart investors build their portfolios. What is the difference between mutual funds and ETFs? Let's break it down in simple terms. Mutual funds have a fixed NAV, net asset value. You can't buy or sell them during the day. Your investment gets processed only at the end of the day. But ETFs are different. You can buy and sell them live during market hours just like stocks. That gives you more flexibility and control. Just one click buy. Another big difference is in the cost. Mutual funds usually come with higher expense ratio, which means you pay more in the fees. On the other hand, ETFs have much lower expense ratio, so you get to keep more of your returns. Next, index funds and ETFs. What's the key difference? A lot of people get confused between index funds and ETFs, and honestly, it's understandable. They look similar on the surface because both are passive investment options. Both track a market index like Nifty or Sensex. Neither has an active fund manager trying to beat the market. So naturally, their performance is also similar. They don't outperform the market, but they also don't fall far behind, except for small differences like tracking error or expense ratio. But here's where the real difference lies. You can buy index funds through mutual fund distributors, registered investment advisors, AMC websites, direct investing platforms. But ETFs are different. They are listed on stock exchange, which means you can only buy or sell them if you have a demat or trading account. So while index funds are easier to access for most people, ETFs give you more control but require little extra setup. What types of ETFs are available in India? ETFs comes in many different types and each one serves a different purpose. Let's quickly look at the major categories available in India. Index ETFs. These track popular market indices like Nifty 50 ETF, Sensex ETF. Next, sectoral ETFs. These focus on specific industries like bank ETF, IT ETF, healthcare ETF. Commodity ETFs. These are linked to physical assets such as gold ETF, silver ETF. Next, international ETFs. These let you invest in global markets like Nasdaq ETF, S&P 500 ETF. Next, depth ETFs. These are more conservative and focus on fixed income. Gilt ETF, liquid ETF, etc. So no matter what your investment goal is, growth, stability or diversification, there is an ETF that fits. Next, how to invest in ETFs. Let's say you have 1 lakh rupees and you are ready to invest in ETFs. Now comes the biggest question. Should you invest all at once or go step by step with SIPs? Let's break it down. SIP method, systematic investment plan. You can invest 15,000 every month and buy a few ETF units based on that month's price. If the market is low, you will get more units. If the market is high, you will get fewer units. Over time, this helps average out your cost and makes your investment more stable. Next, lump sum method. Here you invest the entire 1 lakh at once, but there is a catch. If the market happens to be high that day, your risk increases. That's why it's important to plan your entry carefully. only. Lump sum can work well, but only when timed wisely. Important factor to know before buying ETFs. Here's something most beginners miss, and it can cost you a lot if you are not careful. With mutual funds, the price is fixed, called the NAV, net asset value. Everyone who invests on the same day gets the same price. But ETFs don't work like that. They behave like stocks. Their prices change throughout the day based on demand and supply. Let me give you an example. Imagine a mutual fund with NAV of 100 rupees. You pay exactly 100 per unit. Now let's say there is an ETF with the same underlying value 100 rupees, but because of high demand, it's trading at 120 rupees. That means you are paying 20 rupees extra per unit or 20% more than its actual value. Not ideal, right? Here's how to avoid that mistake. Always check the INAV, indicative NAV, before buying an ETF. You will find it on the mutual funds AMC website. It tells you the real time value of the ETF. Only buy when the market price is close to INAV, otherwise your returns might suffer later. Now here an important note before we move ahead for the top 5 ETFs. The ETFs I am about to mention are completely unbiased. No one has paid me to promote these. This is not a financial advice or sponsored list. Make sure you do your own research before investing. Remember, personal finance is truly personal. The right ETF for you depends on your age, income, risk level and long-term goals. So take this video as a helpful guide, not a final answer. Let's now look at some of the best performing and widely trusted ETFs you can explore in 2025. Each one serves a different type of investor, so choose what fits your goals. First one, SBI ETF Nifty 50. Best for long-term, low-risk investors. Why? It tracks the Nifty 50 index, India's top 50 companies. If you see on the screen, expected annual returns is, for past 1 year, it returned around 10%. For past 5 years, almost 150%. If you see the expense ratio, just 0.04%, one of the lowest in the market. That's a great starting point for someone who wants stable index-based growth over the years. Next one is Nippon India Nifty Next 50 ETF, Junior Bs. Best for moderate risk investors. Why? It includes the next 50 companies in the Nifty 100, just outside the Nifty 50. Here no single stock dominates. Each one is capped below 5% weight. This helps you stay diversified and spread your risk. If you are looking for more growth than Nifty 50 without taking extreme risk, this could be a smart pick. If you see the annual returns for the past 1 year, you can see returns of 0.53, but if you see last 5 years data, a return of 171%. Next is ICICI Prudential Gold ETF, Gold I ETF. Best for adding stability to your portfolio. Why? Gold has low correlation with the stock market. So when the markets fall, gold usually holds strong. Here's the key point. Since there is no new issues of sovereign gold bonds happening right now, this gold ETF became a solid alternative. If you are looking to hedge your equity investments, this one adds the balance you need. If you look at the past 1 year returns, it has 34% returns. If you look at past 5 years data, it returned around 99%. Next, coming up, a small cap ETF that gave a massive 85% returns. Next, HDFC Nifty Small Cap 250 ETF. Best for high risk, high return investors. Why? It tracks the top 250 small cap companies in India. Performance from 2023 to now, this ETF has given a mind-blowing 100% returns, even beating the Nifty itself. Keep in mind, small cap ETFs are volatile, but if you have patience and a long-term view, they can become wealth-building machines. If you see the past 5 years returns, it has returned around 83% returns. The last one, Motilal Oswal Mid Cap 100 ETF, MOM 100. Best for investors who want balanced risk and reward. Why? This ETF tracks the top 100 mid-cap companies in India. That's a sweet spot between large caps and small caps. From 2023 to now, it delivered an impressive 99.5% returns. That's nearly double your money in just 2 years. Mid-cap ETFs are currently in a strong upward trend, making this a smart pick if you are looking for growth without extreme volatility. If you see the past 1 year returns, it has gained around 13% returns. If you see past 5 year returns, 321% returns. Next, risk in ETF you should know. While ETFs offer a lot of benefits, it's important to understand the risk, especially with small cap and mid cap ETFs. These types of ETFs often had a low trading volume and low AUM, asset under management. That means there may not be enough buyers or sellers at a given time, which can create liquidity issues. In simple words, you might not be able to buy or sell them instantly when you want to. Also, small cap and mid cap ETFs are known for being highly volatile. Their prices can swing up or down very quickly even a single day. So if you are someone who can't handle short-term market ups and downs, these ETFs might not be right fit for your portfolio. Next, right strategy for investing in ETFs. Chances are many of you are already investing in mutual funds, but here's the truth. ETFs can offer more benefits at a lower cost if you use them the right way. So before you invest in ETF or mutual funds, keep these points in mind. Always check the 3 to 5 year past performance. Long-term data gives you a better idea of consistency, not just lucky years. Avoid getting swayed by just 1 year returns. Short-term returns can be misleading and don't show the full picture. ETFs are especially useful if you are looking for lower expense ratio, so more of your money stays with you. Live trading flexibility. Buy or sell anytime during market hours. Index-based passive investing. No active fund manager, no surprises. So if you are someone who wants cost efficiency, control and long-term growth, ETFs can be a smart part of your investment strategy. If this video helped you understand ETFs better and gave you clarity on where to invest in 2025, then I would love your support. Hit that like button to let me know you found it valuable. Comment below which ETF are you planning to pick for 2025. I'm reading every response. Send this to one friend who's still confused about ETFs. Subscribe for simple videos on investing and money, and don't forget to tap the bell icon so you will never miss a smart money tip. Thank you so much for watching. Until next time, this is Bala signing off.